we have founders who built companies in Canada that have now exited. They've got some liquidity and now they're reinvesting back into the ecosystem. And a great example of that is the team at Skip the Dishes. I don't know if you've heard of them. They're basically the DoorDash of Canada. So they sold a few years ago, and now they've all kind of split off and started new companies and accelerator programs, and they're reinvesting into the ecosystem. So it's just going to take some more time. We need more startups to hit that liquidity point and then recycle the money back into our local economy. And I think that's what's going to really keep our startups here and our entrepreneurs in Canada.
Hey everyone, this is Prashant and I'll be your host for the VC10X podcast. And today we have Matt Wilson with us. Matt is the founder and managing director at Allied Venture Partners. He founded Allied VC after being a private angel investor since 2012. Allied has since grown to more than 1,400 investors globally, and they've deployed over $3.5 million into early stage startups across Canada and United States. In this episode, we talk about how the Canadian startup ecosystem is shaping up, what's their investment thesis at Allied Venture Partners, involving LPs in the value add and diligence process, some exciting portfolio companies, and how they're tackling the recent slowdown, and a lot more. Without wasting any time, let's dive straight in. Oh wait, if you haven't subscribed to VC10X yet, please do, and give us a 5-star rating if you find value in this episode. And for any insights you gather in this episode, share it on social media and tag VC10X. We'll make sure to reshare your post. Now, let's start. Hey Matt, how you doing? So good to have you on the VC10X podcast.
Hey, I'm great. Thanks for having me.
Yeah, it's my pleasure. So to start things off, can we have your story and some background and how you started investing?
Yeah, so I actually caught the entrepreneurial and investing bug at a pretty young age. I started my first business at age 11 and then started investing in the stock market at age 14. So I've always had a passion for entrepreneurship and investing. I went to university for law. Originally thought I'd become a lawyer. And then after I graduated, realized I didn't like law. I wanted something more dynamic like finance, and ended up actually moving to Toronto as I was pursuing a career as a professional ice hockey referee, believe it or not. And my day job at the time was working various sales and marketing roles. I first started at Nestle, and then I moved over to Coca-Cola for a couple of years. So I really got a behind the scenes look at how the CPG industry worked. And from there, my former business partner and I, we spun out a CPG startup of our own, which we ended up selling in 2012. And from that point, I moved out to Western Canada, where I am now. And I just started doing some angel investing as a way to combine my passions for entrepreneurship and investing. And I really enjoyed working with founders, helping them with their sales and marketing strategies. And it just kind of grew from there. I started writing more and more angel checks. And as my network grew, I started scouting for various VC funds and a couple different VC syndicates. And then in 2017, when I wanted to get more formally involved in the industry, maybe get a job at a VC fund, for example, everyone I spoke to said, if you want to work in VC, you need two things. You need an exit and an MBA. So I'd already had my exit from the CPG company, but I decided to go back to business school, got my MBA, and then when I graduated in spring of 2020. So the pandemic was just kicking off. The timing was terrible. As you recall, like the world was shutting down. Nobody was hiring. No one was doing anything. People were just sitting on their hands and staying inside, basically. So incidentally, my capstone project for my MBA was the business plan for a new venture syndicate based here in Western Canada that would invest in early stage software and technology companies across North America. So after a few more months throughout the summer of running the idea past people and just sort of trying to get a feel for where the industry was going to go and how this whole pandemic thing was going to play out, I decided, hey, what better time to launch it? Let's just go ahead and launch it right now, and we'll see what happens. We'll just see where it goes over the next 12 months or so. So as you remember, Q4 2020, things really started to pick back up. The markets got really hot. And then 2021 was obviously a massive year for funding in VC. So it absolutely exploded. We grew to over 1,000 LPs in less than 12 months. And we just wrapped up our 17th investment 2 weeks ago, and we put a little over $3.5 million to work. So it's been an incredible ride, definitely beyond my expectations, but that's where we are now, investing in early stage companies across North America.
Absolutely. That sounds pretty incredible. And you're investing in Canada, North America, and that's it, or somewhere else as well?
Yeah, geographically, the focus is predominantly Canada and the US. We have companies in both countries. We also have an investment in Australia. One caveat, for most of COVID, I was actually living in Australia for about a year. My wife had a job opportunity there, a temporary contract. So I didn't tell a lot of people that I was in Australia because it saved me time at the start of every Zoom call explaining why I was down under. But yeah, I actually built Allied for the first year entirely remotely from Australia. And while I was down there, I got to meet some really incredible founders because they didn't really have the lockdowns like we had here at the beginning of the pandemic. So there was still pitch events. I could go meet with founders, and actually ended up sourcing a really attractive investment from Australia. But yeah, otherwise geographically, now that I'm back in Canada, our focus is North America.
Got it. Great. And talking about Allied VC, what's your investment thesis over here?
Yeah, so investment thesis, we invest in early stage, so seed to Series A, software technology focused. In terms of industries, we're relatively industry agnostic, but we do avoid stuff like health tech, biotech, and climate. It's just not my area of expertise. Again, geo focus is North America, but yeah, we'll look at anything, whether it's consumer, whether it's enterprise, marketplaces, platforms, fintech, prop tech, you name it. We'll pretty much look at anything.
Yeah, interesting. And I believe Allied VC is actually an angel syndicate, or is it a venture fund?
So we're structured as a syndicate. So that was another thing that I looked at when I was first starting. It's like, how do I want to structure this? Do I want to structure it as a syndicate or a fund? And I know you've had some other fund managers on here, and it is really challenging if you don't have a big track record to go out and launch a fund. So I chose the syndicate approach. I've been investing in syndicates for about 10 years now. So I really like the syndicate model. It plays well to active investors who want to read the deal memo and then choose to invest on a deal by deal basis versus, passive fund LPs who just want to write a check and then get their quarterly or annual updates. So I purposely structured it as a syndicate. That's the model that I prefer. And so far it's been working out really well.
Yeah, absolutely. Syndicate is a great model. And talking about the Canadian startup ecosystem, so how's that shaping up? Do you see some exciting startups coming up there?
Yeah, the Canadian startup ecosystem is really interesting. It's an absolutely fantastic place to start a company and incubate a company. The regulatory environment is very favorable. There's lots of grant funding options. Our visa program is really great as well. So we have a lot of engineers coming from overseas that are setting up shop and living in Canada. And then it's also a really good place for later stage companies, for example, companies in the US who want to hire more talent, they need to expand their engineering teams. So we're seeing a lot of later stage companies hire and get talent out of the Canadian market. And that's great as well because, similar time zones, same language, similar culture, and they're saving 30% on the exchange rate. So it's actually cheaper to hire developers in Canada. But where there is a pretty significant gap in the Canadian startup ecosystem is at that middle stage, sort of that seed to Series A. There remains a pretty big funding gap there. And I've been a proponent of this for quite a few years now. I think we're seeing a lot of companies, for example, that end up raising their seed round and Series A rounds in the US, and then they're gone to the US. And that's been a big criticism of the Canadian ecosystem for a while. So what I've been saying is we need more VCs, we need more accelerators at the seed and Series A stage. Unfortunately, there's some great accelerators in the country, but a lot of them just don't invest in the companies that they have through the program, right? So unlike a YC or a Techstars model where they're actually put in money at the start of the accelerator, the founders can then put their heads down. They don't have to worry about paying their bills for the next 6 to 8 weeks. And then there's a demo day, and then VCs come in and fund the company, and away they go. Unfortunately, with the Canadian ecosystem, it's still pretty young in the sense that we don't have those accelerator programs in place. And then on the VC side of things, VC is still a pretty small asset class here in Canada. As I'm sure you might be aware, Canadians love their real estate. So real estate is still the dominant thing here. And then resources, especially where I am. So I'm based in Calgary, which is the oil and gas capital of the country. So everyone here is focused on oil and gas. So we see a lot of startup founders in technology, for example, they'll go out to pitch and they end up pitching, wealthy oil and gas executives who don't really have the background to assess a SaaS company, right? So we see a lot of them going to the US, and unfortunately, that's just the way it is because our ecosystem is still quite young. But thankfully, we're now starting to see the third leg of the funding stool, which I think is the most important, where we have founders who've built companies in Canada that have now exited. They've got some liquidity, and now they're reinvesting back into the ecosystem. And a great example of that is the team at Skip the Dishes. I don't know if you've heard of them. They're basically the DoorDash of Canada. So they sold a few years ago, and now they've all kind of split off and started new companies and accelerator programs, and they're reinvesting into the ecosystem. So it's just going to take some more time. We need more startups to hit that liquidity point and then recycle the money back into our local economy. And I think that's what's going to really keep our startups here and our entrepreneurs in Canada instead of going to the US, where there's just more funding and more opportunity at the moment.
Yeah, absolutely. So one of the things that I hear, I'm not sure it's true or not, you can confirm, is that in Canada, as compared to US, the taxes are higher in Canada. Is that something that may be stopping owners from going there?
It's possible. Taxes are definitely higher. I mean, if you compare to Florida, for example, where they don't have the state tax. But I mean, there's also a lot of things that you're getting for those taxes, right? You're getting the free healthcare. You're getting lots of great government tax breaks and support programs. So, I mean, it's kind of like, you got to sort of weigh the two. So yeah, taxes are higher, but I mean, maybe I'm biased, but I think quality of life is excellent in Canada. Like I said, the free healthcare. We have a beautiful scenery here. I'm personally next to the Rocky Mountains, so you can go out hiking. You can be in the mountains in half an hour. You can go skiing. Yep. So yeah, taxes are higher, but you're getting a lot for it, I think. So yeah.
Yeah, absolutely. I totally agree with that. The quality of life matters a lot. And one more thing is, like, I believe the Canadian government is also trying to push entrepreneurship in Canada. I got to know of a startup visa program wherein, founders from across borders can actually come in and pitch their startup to a list of accredited investors. And if they are interested, you get a citizenship along with your family, right? So do you see that getting in more founders interested, for the people who might be interested in getting a citizenship to also become founders and businessmen in Canada?
Absolutely. Yeah, that's been a huge driver for us, especially since the pandemic began, is that new visa program that the government unveiled. And I know it can be challenging to get into the US. So we're seeing a lot of founders who are potential founders that want to go to the US come to Canada. I mean, it's a short flight just across the border, and maybe you come to Canada for a few years and then eventually you do get to the US. So I think it's a great option. Canada's definitely taking advantage of that. Like you said, you pitch the company. If you can get some investment backing, yeah, come on over, start your business, hire some people, create jobs, bring your family, and contribute to the economy. So it's been a great program so far. I mean, it's still early days. It's only been around for I think less than 2 years, but so far everything that I've seen from it looks really promising. So I'm excited for the future.
Yeah, absolutely. And is Allied VC also a part of that list? Because I believe there is a list of VCs that the government has given, that only these VCs, if they invest, only then you get to come in, right? So is Allied VC also a part of that program?
Yeah, we're not part of the program at the moment because we're not structured as a fund. So that program, from what I've heard, it focuses more on sort of a select top tier funds. So some of the big funds that have been around for 10, 20 years, a lot of those are over in Montreal and Toronto and some in Vancouver. So for a smaller group like myself, we're not part of it yet, but hopefully maybe one day we'll get asked to be part of the process. I think that would be awesome.
Yeah, absolutely. And now let's talk about how you evaluate startup pitches. So let's say someone has written to you and you sort of like their pitch. Then what are the kind of metrics or factors you're looking at while evaluating the startup pitch?
Yeah, so one of the things I will mention that we do take cold inbound through our website. So we do see a lot of deal flow that way. But yeah, when looking at early stage companies, because we're investing predominantly at seed and Series A, for a seed investment, for example, there's still very little data to go on. So Ideally, they have some type of MVP or prototype in market at that stage, and maybe some early customers. If it's a consumer product, maybe we can, check out some initial reviews or customer testimonials. Or if it's an enterprise product, maybe we can talk to their, initial beta customers or a couple of people that are using it, and just try to get a feel for how the product works, what people like about it. And then also looking at founder market fit. That's a big one for me. Like, does this team or does this founding team have that domain expertise? And are they the most qualified people to do this? Like, I think back to my days as a founder, my business partner and I, we both came out of the Nestle and the Coca-Cola realm, right? So we had that CPG background. So it made sense for us to start a CPG company. So does the team have that founder market fit? And then when if a company comes to us and they're at Series A, for example, there's definitely more data to go on. We probably have, 12 plus months, ideally 24 months or so of data. And then I'll look at sort of what they said they were going to do at their seed round. And then did they do what they said they would do? So we're now raising the Series A. Did they hit their metrics? If they didn't, did they make a pivot? And does that pivot make sense? And is it now working out? And then looking at some of their metrics, are their metrics improving and trending in a positive direction each month, like their customer acquisition costs, for example, or their unit economics, and how efficient are they getting with their marketing, for example? Is it continuing to improve over time? And are their gross margins improving over time? And now it's just a matter of pouring that fuel on the fire to really accelerate their growth, because they've got their marketing dialed in. Now they just need more money to continue those trends. So, and then from there, we'll look at other things, more generic things like market size, the technology. Is it new? Is it innovative? Or is it, just a fourth version of something that already exists? And then lastly, I'll look at the entry price and the economics of the deal. So like the valuation, is the valuation reasonable? What type of ownership percentage we can get? Some other terms of the deal, like, whether it's a safe convertible note, preferred shares, is there pro rata involved? So some of the economics and control components of the deal.
Got it. And what are the most active sectors, maybe within Canada, that you're seeing pitches coming to you? And what are the sectors that you are most interested in investing? I know that you're sector agnostic, but you might have some preferences, right?
Yeah, I like anything. Like, our core thesis is built around anything that enables access or democratizes access to something that historically has been challenging or difficult to get to. So examples would be fintech, or helping people get into banking, or people that are unbanked, or prop tech, helping people buy homes or get into the real estate market. But historically, it's been, there's been high bars to get into that market. Ed tech is another really interesting one. That's one that really took off during the pandemic, because everyone shifted to online learning. So can we make education more accessible to more people? So yeah, anything that really democratizes access and gets more people in and expands the overall market of an existing sector, I think that's really interesting to me. I don't want to see companies that are just going after, a bigger piece of the same pie. I want to see companies that are expanding the pie. So that's what I typically look for in an early stage investment.
Yeah, that's a good take. And let's talk about due diligence. I saw on your website you mentioned that we do proper, thorough due diligence so that it's perfectly fine to invest with us and trustable. So what does the due diligence process actually look like?
Yeah, so I'm a solo GP at the moment, so I do most of the diligence myself. And then typically how that looks is I'll have an introductory call with the founder, or someone will refer the company to me in my network. And then we'll go through the introductory call. I'll get a good feel for the business. The founder can explain it to me in their own words, and then I can answer ask any questions I have right there. And then typically from that point, I'll go into a data room. I'll start to dig deeper, and then we'll go back and forth for a couple weeks with the founder, just to answer any more questions or get some clarification. And then typically what I'll do is I also have, because we're structured as a syndicate, I try and leverage our investor network as much as possible. So I have a bunch of people that are in our network who've offered to be advisors for the diligence process. So if there's a specific area where I don't have the necessary domain expertise to properly do the diligence, I can bring in someone from outside who can help consult on that diligence process. So that again goes back to why I chose the syndicate model, because I want to try and leverage the knowledge of that group, because we have a very diverse group of investors. And, we have people who have founded, multi-billion-dollar companies, to people who are senior VPs at Apple and Amazon. So really try and leverage their expertise where I can. And then from a process time, typically, because I've been through the fundraising process myself as a founder, I know it sucks. It's time consuming. You basically have to stop running your company to go fundraise. It's a full-time job. So I try and keep our process time to 4 weeks or less and move quickly to get to a decision. Again, because we're not a fund, there's not multiple layers of bureaucracy I have to go through in order to get an approval. So, and then I'll put together the deal memo, put it out to the group. They'll typically have 5 to 10 business days to assess, decide if they want to invest or not. And then from there, it's just a matter of, collecting the funds and sending the wire off to the company. So typically 4 weeks or less. That's what I aim for in our diligence process.
Yeah, that sounds great. And that's a great approach of getting your syndicate partners involved in the diligence process as well, utilizing their expertise, right? And moving on to value add. So how do you add value to the companies that you actually invest in, right? What does that value add look like?
Yeah, that again, it comes back to the LP network, right? So I tell founders all the time, we now have over 1,400 members in our network from close to 24 countries. And again, like they have backgrounds, like we pretty much have, someone who's worked at every tech company or has been involved in any type of role from sales to IT to marketing. So I tell founders all the time, like leverage our network. If you have a question or you're having a problem, you're struggling with something, whether it's sales, marketing, HR, you name it, let me know. I'll put it out to the group. And then 9 times out of 10, one of our LPs is more than happy to jump on a 30-minute Zoom call and just help hash it out, right? So leverage the power of that network compared to a typical VC fund where, they have a few institutional LPs or some endowments who are not really going to be able to step up on an operations level and help that company succeed. And the other thing too, with the syndicate model is these LPs have a vested interest in the company's success, right? So they want to jump on a call. They want to help brainstorm and fix these issues and get the company to the next level. Whereas, a traditional endowment or an institutional LP might just be indexing the VC market by writing a bunch of checks and spreading their portfolio across a variety of different funds, right? So they just don't have the time or capacity to step up on an operations level. So that to me is the big value add that I try and convey to founders. And we've had founders that have leveraged that. For example, we had one LP who put $1,000 into one of our syndicates, and then a couple months later, that LP was able to open doors and get the company over $400,000 in non-dilutive funding. So it was, these investors, doesn't matter the size of the check. Like we've had some of the most value come from some of our smallest investors in some of these syndicates. So leverage the network. It's incredible network. It's so knowledgeable and diverse. And that's our big value add that I push to founders.
Yeah, and that's what I personally also love about the syndicate model, that you can also get your network involved and all the LPs involved in the value add process, and incredible stuff. All right, so now can you mention some of the exciting companies that you've invested in that you want to mention on the podcast?
Yeah, again, just going back to our thesis of enabling access, one really interesting company, they just finished up a trip over in Africa, is a company called Phone Bank. And essentially what they do, they enable people in emerging markets to convert prepaid phone SIM cards into cryptocurrencies or stable coins. So, unlike, you and I, when we want to put money into our Coinbase account, we can log into our online brokerage, we can send a wire transfer, we have all that infrastructure in place. But in a lot of emerging markets, Phone Bank lets people go down to their local corner store or gas station, buy a $10 SIM card, and then through their mobile phone, they can essentially convert it into USDC, which is massive, or Bitcoin or whatever cryptocurrency they want. So I'm super excited for those guys. Chris and the team, I think, are doing an incredible job over there. Another really interesting company that I'm excited about is a company called GrowWork. And essentially what they do, they've really taken off since the pandemic began with the whole remote work thing that's going on. So they do IT hardware logistics for remote workers. So, you used to have your IT department. If you had a remote worker, they would have to send out your laptop and your keyboard and your monitors and manage all that equipment. And it was such a headache. And especially with the pandemic now, IT departments are just not equipped to deal with, 100% of their staff being remote. So GrowWork manages all that on the back end for these companies, and they're doing incredibly well. Another really interesting company I'm excited about is a company called Vint. And you may have heard of them. They essentially democratize access to fine wines and whiskeys. So they built a platform where any investor can go in, you don't have to be accredited, and you can buy shares in rare wine and whiskey collections. And it's actually proven to be an incredible inflation hedge over the last 6 months as financial markets have been going down and down. The wines and whiskeys have actually been going up and holding their values. So it's proving to be a great inflation hedge. And those guys are absolutely crushing it right now. And then I guess the last company I'll mention, just going back to, enabling access to people, is a company called Edley. And they're one of the largest marketplaces now for ISAs and income-based repayments. And they focus on high-value careers like healthcare, like teachers. So it's a marketplace where investors can go, like a fixed income investment, instead of investing in bonds, they can go and invest in a portfolio of students that are going through post-secondary education to become nurses, to become doctors, to become education professionals, and help them pay for their education. And those students don't actually have to pay the loan back until they get a job and start working and start making over a certain amount. So it's not like they graduate and then they can't find a job, they're struggling, they're living on ramen, but they still have to make these tuition payments. So I think that's a really exciting company. I mean, you've probably heard of the student debt crisis in the US. It's just absolutely crazy. It's getting out of control. So these guys are really working hard to solve that. So I'm very excited for them.
Yeah, those are some amazing portfolio companies. I especially like the wine one being the hedge against inflation, very sensible. And the last one that you mentioned, again, a big problem, solving the problems of student debt. Like it's huge right now in US, right? And moving on to my last question is like due to the current slowdown in the investment space, has that changed your approach to how you invest? Because everyone is seeing the valuations are going down, it's hard to find investment. So what's your take on that?
Mm-hmm. Yeah, it's definitely interesting times. I was fortunate. I was still really young in high school, but I was able to live through the dot-com bubble as a public market investor. So I did get to see sort of how that played out at the time. And then obviously I was around in investing during 2008 as well. So this time it's interesting in terms of an investment perspective. To be honest, not much has changed from my approach. Since I started Allied and all through last year, I tried to, really stay focused on being price disciplined. I mean, our average entry price, post-money entry price for our seed investments is 11.4 million. So, it's not like we're investing, some of those seed rounds at 100 million or 100 times ARR, that just absolutely craziness that you heard last year. I passed on a lot of opportunities like that. And then I also really tried to stay focused on unit economics and investing in capital efficient businesses, and focusing on founders as well, who really placed a strong emphasis on capital efficiency and were being really mindful in their process and would have, 16 to 24 months or even more of runway post raise. So that being said, one thing that I would say is now playing more into my decision-making process is looking at the ease with which they can raise their next round of funding from new investors. So if it's a long shot company, for example, maybe I have to be a little more diligent in looking at the company and digging a bit deeper on what I think their prospects are, and giving them extra runway in order to ride out this downturn, which I personally think could last upwards of 18 to 24 months. And then also having those deeper discussions with founders. So trying to get a better feel for how they think about capital efficiency and unit economics, and building a more durable business with higher quality of revenues. And if the founder turns out to still be of that mindset where it's growth at all costs, like just go, 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 unfortunately, that would most likely be a pass for us. But if the founder really comes across as more calculated and thoughtful in their approach to building the business, that's probably a company that's going to get funded. So because we don't know what the market's going to look like, 6 months from now, 12 months from now. So looking at, what the downstream funding looks like, what are those opportunities, and are people deploying capital? And if not, then we need to get them, more revenue or more cash on their balance sheet in order to ride this out longer. And hopefully it's over sooner than later.
Yeah. And that's a very, very sensible approach, and probably one of the only right approaches right now by investing, right? So moving on to the rapid fire round, where I'll ask you 5 quick questions about the investments that you make at Allied VC, and you can give some quick answers. All right. If you're good for it, we can give it a go.
Let's go.
All right. First one, industries and regions you invest in.
So industry agnostic, except health, bio, and climate, and in geographically North America, so Canada and the United States.
Got it. And what stage you typically invest in?
seed to Series A.
What's the typical check size?
100 to 350,000 USD.
And where can founders pitch you?
So the best place is on our website, allied.vc/apply.
And where can our listeners follow you?
Yeah, follow me on LinkedIn or Twitter. My name is at Matt Wilson, YYC.
Got it. I'll make sure to put all the links in the show notes below so that our listeners can get there easily. Great talking to you, Matt, and thank you for coming on. Happy investing.
Thanks very much for having me.
My pleasure.